So basic strategy for futures and options trading. Most traders and investors fear futures and options trading as they might have to face losses. But is it really a good idea to be scared of futures and options trading? Or is it better to learn about them and look for futures and options trading strategies? You tell me, which is the better thing to do? Well, what is up? My name is Rohit Bhosle and I am here with another exciting topic that covers the basic strategies for futures and options trading. Let's begin, shall we? Yes. So we are going to learn about them. So I suggest you keep your notepads ready and your nerd caps on. Let's get started. If you're still blurry about what is futures trading and what is options trading, then we have already made a video about that. You may find the link in the description below. So coming to the basic strategies that can be used for futures and options trading, let's walk through the futures strategies first. Futures trading strategies. Long trades. So long trades are a popular way to trade futures. When you buy futures, you're hoping that the underlying asset's price will rise before the contract's expiration date. The more the price rises over the agreed upon price between you and the seller, which is called the strike price, the more profit you can make. Short trades. Short trades are when you sell futures contracts. When you sell a futures contract, you are speculating that the price of the underlying asset will fall before the contract expiration date. Short transactions are often regarded riskier than long trades since losses can be large if the price moves in the opposite way. Bull calendar spread. So in this futures trading strategy, the trader buys and sells futures contracts that are based on the same underlying asset but have different expiry dates. The trader usually buys options with a short expiration date and sells options with a long expiration date. So when investors use this strategy, they want the spread to get bigger in favor of the long position so that they can make more money. Then there is bear calendar spread. So the opposite of a bull calendar spread is a bear calendar spread. In this way of trading futures, the trader sells short on the short-term contract and buys long on the long-term contract. So investors who choose this strategy want the spread to get bigger in favor of short so that they can make more money. Well, seems a little tricky for now, right? But don't worry, you will get the concept once you start doing it practically. And for that, you need a trusted stockbroker that's also charging a lower brokerage compared to others. Yes, that's aliceblue. Open a Demat account now and start trading in futures derivatives. Remember, you can always reach out to us in the comment section below. Now, let's move on to the other aspect of this video, the options trading strategies. Let us first cover the option buying strategies. Long call option. One of the most popular ways to invest in options is to buy a long call. So you can make this trade if you are sure that the price of the underlying asset and the strike price will go up before the end of the contract. Remember that time can harm your choices. The faster you make money, the faster the price of the underlying asset goes above the strike price. But if the price goes up on the last day of the contract, you may also lose money. Then there is this strategy called short put option strategy. So when you buy a put, you think that the price of the underlying asset will go down in the future or before the end of the contract. If the price of the underlying asset goes down below the strike price, you make money. But if the price of the asset goes up, the price you paid to buy the put may be worth nothing. Bull call spread option strategy. A bull call spread is an options trading strategy that lets you make money from a stock or index's price going up by a small amount. The strategy is done by using two call options to create a range with a lower strike price and an upper strike price. So when you are moderately bullish about a stock or index, a bull call spread can be a good way to make money. If you think the stock or index has a lot of room to go up, you shouldn't use a bull call spread. Understood? So let us also discuss about bull put spread option strategy. So in the bull put spread option strategy, one short put with the highest strike price and one long put with the lower strike price is utilized. Keep in mind that both puts have the same underlying stock or index and expiration date. Similar to the bull call spread, the bull put spread can be a profitable strategy when the investor is relatively bullish on the underlying stock or index. So if both bull call spread and bull put spread are comparable, how do you benefit from the fact that they are among the most effective strategies? Well, the distinction is that the bull call spread is performed for debit, but the bull put spread is done for a credit, meaning that money flows into your account as soon as the trade is executed. Now, let us also take a look at option selling strategies. So there is a strategy called short call option strategy. A short call is a strategy that uses a call option. So if the option is exercised, the person who sold the call has to sell the security to the person who bought the call at the strike price. So a short call is a bearish way to trade because it is a bet that the price of the underlying security will go down. Long put option strategy. So a long put strategy is a fundamental approach with a bearish market outlook. The inverse of long call is long put. In this case, you are attempting to profit from a drop in the price of the underlying asset. So the risk is limited to the premium, but the rewards are limitless. Bear call spread option strategy. Bear call spreads are a strategy that collects option premium and limits the risk at the same time. They make money from both the loss of time and the fall in stock prices. So when prices are expected to stay the same or go down and you want to limit your risk, you should be using a bear call spread. Now, there is also this thing called bear put spread option strategy. So a bear put spread is an option strategy used by an investor who thinks that the market will go down and wants to make the most money while losing the least. This is what everybody wants to do, right? So a bear put spread strategy is when you put buy and sell puts on the same underlying asset at different strike prices, but with the same expiration date. Now, there are also some neutral trading strategies. Let's understand that. Long strangle option strategy. In a long strangle, the investor simultaneously purchases an out of the money call option and an out of the money put option. So the strike price of the call option is greater than the current market price of the underlying asset, whereas the strike price of the put option is less than the asset's market price. Short strangle option strategy. So with a short strangle, you have to buy the stock at strike price A and sell it at strike price B if the options are assigned. So you're predicting that the stock price will stay somewhere between strike A and strike B, and the options you sell will be worthless when they expire. Long straddle option strategy. So a long straddle is an option strategy in which the trader buys both a long call and a long put option on the same underlying asset with the same expiration date and strike price. Then there's also a thing called short straddle option strategy. So a short straddle is a strategy that involves selling both a call option and a put option with the same strike price and expiration date. So it is implemented when the trader feels that the underlying asset will not move significantly higher or lower throughout the term of the options contract. There's one such thing called butterfly option strategy. So a butterfly spread is a type of option strategy that mixes bull and bear spreads. These are risk-adjusted neutral strategies with capped earnings and losses. So butterfly spreads are most profitable when the underlying asset does not move before the option expires. Options hedging strategies. Iron condor option strategy. An iron condor is an option strategy that consists of two puts, one long and one short, and two calls, one long and one short, with 4 strike prices and the same expiration date. The iron condor makes the most money when the underlying asset closes between the middle strike prices at expiry. Collar option strategy. A collar option strategy is an option strategy that limits both gains and losses. A collar position is formed by holding an underlying stock, purchasing an out of the money put option and selling an out of the money call option. Butterfly option strategy. A butterfly spread is a type of option strategy that mixes bull and bear spreads. So these are risk-adjusted neutral strategies with capped earning and losses. Butterfly spreads are most profitable when the underlying asset does not move before the option expires. Long calendar spread with calls option strategy. A long call calendar spread is created by selling one call option and simultaneously purchasing another call option with the same strike price of the underlying assets but a different expiry date. long calendar spread with puts option strategy. A long calendar spread with puts is formed by purchasing one longer term put and selling one short term put, both with the same strike price. This technique is designed to generate a net debit, net cost, with both profit potential and risk being restricted. On the expiration date of the short put, the highest profit is received if the stock price is equal to the strike price of the puts, and the most risk is realized if the stock price goes dramatically away from the strike price. So these strategies will surely help you make better and calculative decisions while trading options derivatives. So what's the wait? Open a demat account from the link in the description and get started away. This was all in today's video. Next time I will see you with another exciting topic. Until then, do subscribe to our channel, comment below if you have any doubts regarding the strategies that we discussed today, and share this video with all your trader friends you know. That's all from my side. This is Rohit Bhosle signing off. I'll see you in the next video. Till then, you have an amazing time. Bye-bye.
Investment in securities markets are subject to market risks. Read all the related documents carefully before investing.